Marc from ADM Investor Services International, with some thoughts on what's going on with central banks, what's going on with government bond issuance, and market reaction, and how market reaction may evolve in coming weeks. My starting point this week is market levels of market implied policy rate levels for the next 3 years. As one can see from the table, basically what we've got, despite the chatter about negative interest rates in the UK and indeed in the US, thanks to guidance from both the Bank of England and indeed the Federal Reserve, is a situation where we've been flirting with the idea of further rate cuts. We are no longer doing that, and we are now looking at a very flat profile for implied policy rates over the next 3 years, barring a couple of countries like South Korea, but even there, we're still talking about minimal, perhaps one more 25 basis point rate cut. So how does this bear upon the flows in financial markets? I think we've reached an important point this week, and so my second chart is comparing the Fed's balance sheet and comparing that with the total volume of US Treasury issuance. This is both bills, bonds, and any other issuance that they have, and basically to look how that nets out in flows to financial markets. As we can see, they've been adding for quite some time. The Fed liquidity injections have outstripped Treasury issuance. This week, that turned a negative 162 billion. And that's important because basically it means the Treasury is absorbing a lot more of the extra cash and indeed demanding even more from the market than the Fed is actually pumping in. And that changes the dynamics of flows into financial markets, given that the Treasury is basically crowding out, for want of a better word, investments in other assets. This brings me to my third chart for this week, and that is highlighting the level of US dollar investment grade corporate bond issuance over the past 5 years. And above all, to highlight that we've actually this week gone over the magic $1 trillion year-to-date mark, and how that compares with prior years. Basically, compared with 2019, what we're talking about is year-to-date issuance, indeed, basically almost already outstripping the total volume of issuance that we saw back in 2019. And that's an important point. Thus far, one can say when one looks at the volatility indices, though I have a couple of other observations about them, it's not having a huge impact. I've got the VIX index, and as we can see, that's basically descended. It's come down a long way from the highs that we saw back in March, but it does seem to have bottomed out around the 28-29% level. And indeed, when one looks at the V2X, that's also the same case. So how does this bear out in the short term? Well, I think it creates probably with less net money available via the central bank liquidity injections for other assets, it basically presents a slightly more challenging environment for riskier assets. And I think the longer term thought is we've had a huge amount of debt for equity swaps via the financial engineering that's gone over the last 5 years. If we're in a scenario where we're going forward and basically we have a slower recovery than people expect, corporate profits don't rebound, then we're probably actually going to be in an environment, particularly in the banking sector, with a lot of liabilities that they will want to jettison, where there will have to be rights issues in the equity market. And that means basically a changing dynamic in the relative. So instead of having buybacks, we'll have rights issues, and that will give a completely different dynamic to financial markets.